All right, Science Flipping podcast listeners, as always, this episode is brought to you by Rocketly.ai. If you're looking for a seller lead generating system that has automation, an AI bot, and has sellers coming to you, then Rocketly.ai is your choice. Make sure you head over to the website, fill out an application, and schedule a demo now to see the power of Rocketly.ai. What is up, Science Flipping family? I am back with an incredible guest, a close friend of mine. This man has over 1,000 doors. He's been doing this for over a decade. He's an expert real estate investor, but he's also a licensed accountant. He knows his damn numbers. Casey, Ryan Quinn is in the house.
What's up, my guy?
I had to make sure, I wanted to throw that Ryan in here to make sure, know who you are.
So our guy Ken always makes fun of it now from when I run on stage at Boardroom. Casey, Ryan, Quinn.
Casey, right. I mean, that's why we're going to do it. So first of all, go follow this man. I talk to him a lot about, buying more and more property. So if you are buying any level, whether you're flipping, whether you're buying and holding, you need to know your numbers, and we're going to dive into it. But first, where does your real estate portfolio stand right now?
Yeah, man, we're up over 100 million. And it's funny, you said I've been doing this over a decade. Yes, I've definitely been doing finance and accounting over a decade, but tomorrow marks 5 years since I started investing in real estate. So in 5 years, we've been able to build over $100 million portfolio. To your point, we're right approaching 1,000, not quite there. We've definitely sold a bunch. We've done a bunch of flips and things, but we would have been at over 1,000 doors if we never sold anything. But
sometimes,
we'll be there soon enough. We've got another 40-unit deal we're closing this week. We buy 3 properties. We're buying a property every 3 days at this point, a single-family home in our local market. So it grows quickly at this point.
So are you more focused on single-family or multi,
I would say both. I mean, we're making some moves here to get into the multi-family space. It's been tough over the last year. We did in February buy our largest deal to date, which was a 98-unit deal.
Yeah.
Really cool deal. I got 95% seller financing by structuring it absolutely wildly.
Right.
We took over the existing LLC as the GP, restructured the whole thing. 50 G's in legal on that one, but
so some money out of pocket.
Yeah, I mean, listen, we bought it for $7.5 million. Right now, today, it's worth a little over $9 million, significantly under market rents as it sits as well. So the really weird caveat to it all is there's a stipulation of the gentleman that owns the property that is now an LP on the deal that structured the entire deal, manages it on behalf of his mom. And so they're essentially not selling it, if you will, and we were able to create this arrangement until mom, unfortunately, decides to
no longer be with
follow Jesus and God to another world. So
when a deal like that has to get that creative, do you get in the trenches and structure the deal yourself?
Oh, that was 100% me. I love deal structuring, especially on the multi. The single family stuff, I typically don't get involved with the structuring. I manage over top. We burn most of those.
Base, right?
Yeah, and I have a team. I mean, the financing stuff I'm definitely still involved with. I have all our banking relationships. I review all of the underwriting before it goes to the bank. So I still do that. I mean, that's probably an hour every 3 weeks. It's not a lot anymore.
Yeah.
Because we have such a routine. But the multifamily stuff, I'm still very actively involved. That specific deal, I was involved from day one. Early on negotiations, I handled the entire negotiations. I handled deal structuring. I even managed the legal on it all because it was so complicated. But the 40-unit deal, for instance, I wasn't as involved. I don't handle, the basic underwriting. I review it all. I don't handle the due diligence anymore. I don't even handle the attorneys. My COO handles that.
Yeah.
So we'll buy a 40-unit deal where I probably spent 5 to 10 hours total on it. We've been able to really build a good infrastructure, right? Because, again, it's all about me finding my time to manage my team because we have such good numbers.
Yep.
We have such good bookkeeping that we understand our business and don't necessarily have to be trial by fire, if you will.
So you're ahead of me in terms of where I want to get. And there's so many, as I'm growing and we're going to buy another apartment here, I think we close the end of this month. So that's 3 apartments in this year alone.
That's great.
It's not
ahead of most.
Yeah, it's not high door counts, right? So this one's 16 units or whatever. But my point to this is, the more I delve into the commercial side, there's so many ways to structure it.
Yeah.
And why I say that is because Grant Cardone last month or last week or whatever just funded the largest all-cash apartment in the state of Florida for $150 million.
Wow.
I'm pretty sure I understand his structure. He goes in and gets a fund. He raises it through the fund, buys it all cash.
Yeah.
He also,
which right now is a really good idea. We're actually in the middle of conversations, a couple partners and I, where we're going to go after big multi, and we're doing it that way as well, where we're going to close all cash through investor capital that we raise, and then quickly turn it to refinance it on bank maybe a year or 2 years later. But
so that's what I was going to go. So his model, he takes a pretty large acquisition fee, correct? I don't know.
Cardone does, yeah. He's actually got sued for it before. Cardone did.
But he's doing it the right way.
As long as he discloses it all and talks about it all, as long as his marketing's on point.
Yeah.
Right. And that types of deal sizes and the way they structure that with the SEC, as long as you're following all the rules, we could charge whatever you want. I actually had a deal, another guy that I was in on a deal with, he did another deal where he took a 25% acquisition fee. And he didn't tell me about the deal, obviously, because he knew I would not be happy with that, because I understand real estate. But if the numbers pencil, you know what I mean, then the investors are happy and they're willing to invest still and take whatever you want if it pencils.
So how do you guys structure when you go for multifamily commercial?
Yeah, so obviously the 98 unit, we didn't raise any capital because I got 95% of the capital from the seller. But we've done 4 syndications in total on 4 multifamily deals, and all 4 of those I've structured identically, super simple. What we do is 75, 25%. So we take the 25% equity. We bring no cash to the table at all. 75% is the cash to the table, and we do 8% preferred returns paid quarterly.
And that's all in an entity. It's basically, you're not going and creating a fund. You're going and creating an entity. You're getting the operating agreement that shows their ownership in that entity.
It's similar to a fund. It's a syndication, and so it's a.
But you can use that word a couple different ways, right? Like you can create a syndication of a property. Like right now, this third one, we're going to syndicate it, but all the investors are going to own the LLC.
Yeah.
Right? Instead of going,
same concept.
Yeah. Instead of going and getting the actual fund and spending the $15,000 to $25,000 to go get the,
Yeah. Really, it's just a different way to look at how you're spending money on legal.
Right.
If you got a bunch of partners coming in on a JV, right, a joint venture or operating agreement, you're still going to need an attorney to make sure those stocks are really good. You're still going to have to answer attorneys on the other side, right? So it's just a different way to fund it and a different way in how you have to report to the SEC, right? There's Reg A's, there's Reg D's. There's all kinds of different
this is just an
ways to do it.
And I find at the price point, this is like 1-1, right? So at that price point,
it's not worth all of it.
No,
correct.
It's not. And that's why I said, listen, instead of going through this route where we can get the whole fund and the Reg A or whatever, let's just go have you guys be GPs, true ownership, et cetera.
Yeah,
right?
It depends on the deal size, right? I'm closing next month. I'm less than a month away now on a 40-unit deal. We're acquiring that for $2.4 million. And instead of doing a syndication, instead of raising a bunch of money on that specific deal, I needed $700,000 to come in for our equity on the deal. I gave that to a partner. They're bringing all $700,000, just one person for that deal.
I'm part of the LLC.
So the deal that we structured to make it easy, I gave them 50%.
Yep.
So we're splitting a deal 50-50 on equity side, and then their money's actually coming as debt.
Yep.
With an 8%, 8%. It's not really a pref, it's interest, right? Because they're going to be higher up on the balance sheet because they're debt.
Yeah.
So their $700 is just going to be debt at 8% interest for 5 years.
So that's the same thing. I just have 4 players. You have 1 player.
Yeah. And that's it. I mean, it makes it a lot easier.
As debt at 10%. I want to get your 8% guy, but they're coming in at 10%.
Yeah.
Part of it is I just overperform, right?
Well, 10% is tough, but in this market, it must be a really undervalued deal because you're probably going to add.
We're at
value.
Massive value.
Yeah, because 10% right now on a stabilized asset is really tough to pay off.
We're buying it at $300,000, putting $750 into it.
Yeah.
So we're basically buying a shell.
Yeah.
Right.
So we're building buying land.
Yeah. And so, which for someone who has some limited apartment, I like it. Meaning, I have a blank canvas. I don't have to go get tenants out. I don't have to wait.
Do you have, up the top of your head, I bet you don't know this answer, but this is me right into the numbers. The 750, how much equity values I can add to the property?
About $1 million.
About $1 million. So you're going to put 750 in and create 1.75 in value to the property. So you can afford 10%. Now, make sure you can pay it out. So you're either going to have to defer the payments or raise enough cash that the cash itself can pay back during the renovation period. I'm sure it's going to.
Well, it's all back ended. Right, so they get their money when the money comes back out from the refi. Yeah. So because we'll be into this, call it 1-1, it'll have some sort of valuation of, I mean, who knows? But we're guessing somewhere between 1.6 to 1.8. All of the money is going to be coming out of the thing.
Yeah,
right.
So that's so you can afford
patient.
Yeah, 10% is nice, really good actually
because the numbers work. Right,
they're not every deal. So their IRR to they're counting on timing for you to perform. Right, maybe it's a year or 2 years, but if you push that thing right, and you're going to do it all right away, I'd imagine. IRR comes down because they're not seeing cash on a monthly basis, on a quarterly basis. My deal is 40 units. It's fully occupied. We're going to turn them all.
Yeah.
But it's already cash flowing, right? So the 8%, we can afford to pay that out, but we can't afford to pay much more, right?
As a real estate investor, one of the most challenging hurdles you'll face is figuring out how to fund your first project and then how to keep the money rolling in for all the projects that follow while holding on to as much of your profits as you can. This is a challenge that today's sponsor, Fund and Grow, knows all too well. They've built a strategy that has helped tens of thousands of real estate investors access 0% interest business credit for their first, their third, their 10th, even their 100th deal. They've been in the game since 2007 and are experts at helping investors with their 100% done-for-you business credit program. They'll do all the heavy lifting and negotiating to get you approved and teach you how to use the credit like cash without any crazy expensive fees. And you get to keep financing your deals at 0% interest. So head over to fundandgrow.com/flip to learn more about the program. There's also an option for a free pre-qualification to see how much you could qualify for. It's super simple and will take less than 2 minutes of your time. Again, that link is fundandgrow.com/flip. This part really excites me. So you and I would be able to geek out about, like, this is the space I want to just keep pushing into.
Heck yeah.
I like the blank canvas. I know they're just hard. Like, we've just lucked out to be able to find 3 apartments that we've been able to have the opportunity to build out. But they're in those type of neighborhoods also. I'm not buying necessarily in B&A neighborhoods, and it's because the numbers make so much more sense. So I'm also going to do something I've never done before and go Section 8. I'm going to Section 8 all 3 separate apartments.
I love that, man. We'll have to talk offline. I can give you a lot of...
Let's go.
Yeah, I got a lot of...
It doesn't have to be offline. Let's go. Let's teach the people.
No, I've got a lot of Section 8 in my portfolio. The crazy thing right now in my town, if you put $10,000 into a renovation project at a home, Section 8 gives you another $1,000 a month for the full first year that you put a Section 8 tenant in there. And right now, Section 8's paying above market rent. So we got a unit, for instance, that might rent for $10.99, right? Fully renovated unit that we add over $10,000 into it. Well, Section 8 right now might be paying $14.99, but if you put $10,000 into it, they'll actually pay $24.99 a month for a full year. So you're getting $12,000 back on a $10,000 renovation back in the rent year. So it's free renovation, plus you're getting above market rents from Section 8.
Follow this man right now, Casey Ryan Quinn on Instagram.
The reason is just because, affordable housing is it's such a it's really hard to find right now. And so the government has to do something so that they don't have people living all over town, right? Especially depending on where you're at. This is in Pittsburgh.
Right.
So I can only imagine the bigger cities. If you get to a bigger city, it's even better.
So I'm buying in Birmingham for what I think most people are going to see here in the next 4 years. People can't afford to live outside of areas that aren't priced the way Birmingham's priced. Right.
So this is exactly why we bought. I'm from Pittsburgh, but kind of got lucky. I massively believe investing in your hometown. I get it. When you live in Miami, you can't.
Not as
right.
easy here.
It's a lot more difficult, but it makes it way easier for us. But we also knew coming into this thing, Pittsburgh was the cheapest market in the country from a cost of living perspective. And so we knew we could only go up compared to the rest of the world, right? The rest of the country. So we've got lucky from that standpoint too. Just this last year, we're actually the fastest growing home prices in the country, right? It was all over Redfin and everything else.
Pittsburgh.
Yeah.
Pittsburgh.
22% year over year, I believe it was. Now, we're not taking massive advantage of that.
Doubles, that's insane.
When we get to a point where we're ready to, recap all of our recapped properties.
But it's the long game. I think that's the other thing. I think you and I also realize I'm not doing this to go essentially get rich now. Yes, I make a lot of money and whatever, but it's more about the long game when you can go back in 5 years and say, hey, this thing's now worth 2.8, not 1.7, right?
It's incredible, right? And, I know we want to get into a little bit of talking numbers here later on the podcast, but the really cool thing is if you could figure out how to live your life and do things where you make money outside of the actual investment in real estate. So instead of flipping it, right, if you can have a coaching program, or you could do something where you're making enough money that your lifestyle is okay and you can keep more of the real estate.
Yeah.
And it's a numbers game, right? And really understanding how to look at a balance sheet and how to understand the wealth that you're creating and how easy it is to borrow, right? And to build your wealth by looking at the numbers, because the reality is, let me just want to run through an example right now of a single family home and why I preach keep it. So I'll give you an example, right? And I'll keep the numbers simple. Let's say we buy a home for $150,000 and we're planning to flip it. And so we're going to add $100,000 to it. So we have a $250,000, we're all in for $250,000, and we could sell it for $400,000.
Okay.
Right? So it's a really nice profit on that. We can sell for $400,000. Okay. Right. But let's just say, right, we're going to sell at $400,000. We're going to pay selling costs. In Pittsburgh, it's 5% transfer taxes. So we're going to pay 2.5% of that. And then we got realtor fees, unless we're our own realtor, which I would love for all realtors. And I own a brokerage as well.
Yeah.
But let's just say you don't, right? And you're going to pay 5 or 6%. So let's just say 5. You pay half of that, right? I'm sorry, no, you don't. You pay all of it. So you paid a full 5% realtor fee. So you're at 7.5% of your $400,000 that you owe out, plus other closing costs, plus most of the times when you sell a home, right, you're selling to a first-time home buyer on a flip. Well, guess what? They're going to come in and beat you down through inspection because it's not going to be perfect. Let's be real here. They're going to nickel and dime. They want a perfect home, so something's wrong with the basement, whatever, called 2%.
Yeah.
So you're looking at roughly 10% that you're going to pay. So $400,000 less $40,000, you're actually going to net like $360,000. Okay. Not only that, when you flip a home compared to when you keep a home for rent, there's certain things when you renovate the home that you don't have to do, right? Because you're not selling to an end user homeowner, you're just renting it, like finished basements, right? Or like there's certain things in the home, right? It depends on your market. For us in Pittsburgh, we have a lot of wet basements, right? They're unfinishable. So you have to go in and you have to pay to all make it clean. Is that the
term when something's unfinished, it's wet? Or
it's literally
so damp
wet. It's literally wet. Yeah. It's literally wet in our town where it's damp, it's moist.
Yeah.
But that plays a tool, right? So a lot of times you'll have to paint over the walls, right? Different things. And so for us, it's like $20,000 usually that we have to put in an additional capital every time we flip. Because when COVID took off, we flipped probably 30 homes.
Yeah.
Right? We were flipping a lot because it was like, oh my God, we can take advantage and make it ridiculous.
Sure.
We were making good money on the flip because they were paying way above appraisal value, right? And justifying that. So we have to do that. So call it another $20,000. So you're at 10%. So 400,000 less 10% is 40,000 plus another 20,000 is 60,000. So you're really only going to net probably, right, 340.
Yep.
If you go refinance that home, because you can get money from a bank and you can get an 80% loan to value on the home and rent it, you're going to get 320,000. So the difference is only 20,000, right? But you have a cash flowing asset in building wealth, and you have all of that net equity wealth sitting on your balance sheet, on your personal financial statement, so you can go borrow more. You're worth more money. You're richer.
Call it bankability, right?
Bankability, right? So
and I don't even know
that on repeat, right? The bank's giving you more money, and all you really had to do is give up 20,000 on that specific
But
deal.
this is why it's really important for someone to have income that they don't have to rely on. Like the sole fix and flipper, a lot of times that's hard, right? This is your only income. So you want that extra 20,000 because the next flip might take,
Let me take it one step further for everybody listening. We didn't talk taxes.
True.
So you could sell it and you can net 340 of 250 into it, you make 90,000. You refinance it, you get 320, right? 80%. The difference is 70,000 that you get. So you could pay taxes on 90,000 or you can get 70,000 tax free.
True.
Which one do you want? Right? Do the math.
Now, are you seeing those numbers in today's financial economy?
It's definitely harder. It's definitely harder for us, like that exact example, where when the market was taking off, we were netting a good 30, 40 grand per refi, tax free, and we were able to scale the business. Right now, our goal is to break even on all of our bursts. Okay. Right? So our goal was to essentially get into it and get out of it with no money. A dead zero break even. Now we have some wins, we have some losses, but we do it at scale. I mentioned at the beginning, we buy property every 3 days now.
Well, that's the key. So I'm on that kind of buying trend is every 2 to 5 homes a week. Just some weeks are higher and lower, but at scale, these numbers work. A lot of the people aren't at my level, your level, right? So we also have to understand to get there, you can have some wins and losses, and at scale, the wins outrun the losses, right?
Yes.
And losses to you is like you have to leave 10 grand in the deal. That's a loss.
That's a loss. It's not really a loss.
It's not really a loss.
Yes.
Right.
I always talk about that to a lot of people because we evaluate that as a company. We have 50 employees, and we always talk about a loss. The reality is it's not really a loss. Think about any home anybody's ever bought. You have to put money into the home.
Right.
When I buy my home that I live in currently, right, I put 20% down. That's how much money I put into the house. Now we're saying $10K we have to leave it, and that's it per deal. That's a loss.
Well, in the Pittsburgh market, what are you looking at in terms of net revenue a month on a single family?
Our goal is always 200 to 250 net cash flow per month per property.
What happens at the refinance stage? This just happened to us. That's what I'm going to ask. It goes to $76 a month net, but you could go make 40 grand on a flip.
It's a tough call. I'd evaluate what you need. I would still say keep it if you can, particularly in any market that you're ever in, because look, appreciation is real. And so if you can afford to keep it, $76 a month in cash flow and that net wealth of which you can continue to borrow on as you grow, because banks like you more, you're more bankable with the right back office in place, of course, because you have to be able to track and show that well. Yeah, we have a lot of deals that don't pencil at $250 a month. The reality is they don't. I really don't even count on the cash flow.
Right.
Like we look at that all as bonus, right? Because we have a management company that we're paying, and we want to continue to scale that business independently and separate.
Yep.
And so we're adding a bunch of value in other places for us that we're okay if we lower that cash flow.
For sure.
On those deals. So we definitely have lately. We always try to maximize cash out, right? So if the question is, hey, you can cash out and get an extra 10 grand today to get to break even, but your property's not going to cash flow, I'll still take that all day because we're scaling and growing.
So again, at scale, that makes sense. But for the person that has 1, 2, 3, 4, 5 rentals, what happens in that maintenance? Tenant tears the thing up, maintenance, breaks a window, and you're essentially net even.
Yeah.
At scale, you can afford to take that L. But for the person who owns, this is why I have a hard time advising people to go buy a rental or two. Learn what we know about raising capital, learn what we know about syndicating and all the different ways of syndicating, because you don't need your own money and you can actually go buy a rental a month. A rental every 2 months is better than...
Justin, even that, I still believe, even if you have to put $2-3 grand into it every year, you're still getting all of the net equity. You're still getting the appreciation on the property. Most likely in most cities across the country, you still out-appreciate it.
What's the point, right? That's my... So I guess where I'm going is you got to be able to go, I'm going to go buy... I want people to go buy 1 a quarter.
I love that.
Right, because even if you're a W-2 employee, again, there's ways to raise money. We're going to go start traveling the world and speaking together about how you've raised money, how I raise money. There's ways to raise money that even if you have a W-2, you're a licensed accountant, even if you're stuck being a true accountant still, the big four, you don't have to use your own money, and you can go buy these things without having any of your own cash.
I say, partner with somebody.
Totally.
Right? If you have a couple bucks because you have a really good job, partner with someone, make sure you're getting one a quarter.
Yeah.
Right? Or if you don't and you have the time, find someone that has a really good job that they're willing to partner with you, because 50% of 4 single-family homes a year is still great wealth, particularly in our market where we know inflation's real. It's always going to be real.
Totally.
It's still a great retirement.
Well, we just talked about it. You're doing it on one of your apartments, right? 700 grand's coming in. You're doing a partnership agreement.
Yeah.
I'm doing it on one of my apartments. I'm basically syndicating the ownership group, right? So it's going to be an ownership group. I say that because it's relatable in terms of ownership groups by football teams, baseball teams, ownership groups, right?
Yeah.
Percentage ownership. People can do that, right? If you're listening or watching this, you could go hit up Casey, go hit up me. I mean, there's opportunities out there that we're always looking for something bigger. Today's episode is brought to you by our friends at Bateman Collective. Pay per click can be an awesome lead gen channel for investors, but you need tons of data to make it work on your own. That's where Bateman Collective comes in. They have the data and the expertise to help you unlock PPC as your top marketing channel. Take the risk out of PPC and go with the experts. Go with the best. Get a free strategy consultation to see how they can drive consistent, motivated seller leads to your business. Go to batemancollective.com.
I mean, we've talked about this before, but I've never used a single dollar of my own money to build a $100 million portfolio. And reality is we have 5 or 6 deals total that we don't have 100% equity. We have over 300 single-family homes that my partner and I own 100% of all of the equity in all of those deals, right? By using other people's money. The reason is we have a really clean, good back office that we can show exactly what other folks are getting into, how we manage the capital, how the investment's doing, how's the deal's going to do. Even those deals that we talked about that might be short-term losers, if you will, we had to leave a couple bucks in there. no problem, right? We have borrowed debt on the back end that sits there. And guess what? It gets paid off, right? And we're maybe not cash flowing as well from the deal because we have to pay off that second position debt.
Yep.
But no problem. We still own the equity in the property. And the last I checked, it's going up. Rents are going up. Single family homes are really cool because it's not just based on rent, because you could always sell it to a homeowner.
That's right.
Right? On the multifamily 5+, you're always generally going to be selling that to an investor. And so it's much more based on what's rent going to do. That's how the value of the property goes up. More based on cap rates, which I don't think we want to get a ton into that. But,
right.
That's ultimately based on what's your market doing. What's the market saying? What are interest rates?
I
what
think
is rent?
People who don't continue to do both are short-sighted. And the reason why I say that, people get so drawn into Grant and his whole apartment thing. I love it. It's not wrong. It's right. But it's an and, not an or. You're echoing it. I'm going to say it in a different way. A single-family home, you could do a seller finance deal where you now no longer need to be the landlord. You can sell it for a premium, get your cash flow each and every month, which elongates the payoff, so your tax situation is even better. And then there's a lot of times where those buyers default, and you get to go do that again and again. You're likely really going to only focus on single-family homes in that. Same way you can flip it, but you have multiple exits with the single-family home.
Yep.
To your point, really everything's based around rents, cap rate, etc. You're really looking for an investor, right? So you don't quite have as much wiggle room as you necessarily would with single-family. I think it's an and. I'm going to continue to buying single-family homes all day long.
Justin, I can't tell you how many people have, very successful people, especially a lot of people in the multifamily space, have said, why do you still do single-family homes, right? And this is along the way before, people said, when I first said I'm going to start going into multifamily too, when we had some track record, we had some experience, and we wanted to start branching into multifamily, people would say, well, you've got to stop single-family home. And I always said, I'm going to do both. Yeah. Why wouldn't I do both? Yeah. Single-family home is such it's much less risky at the end of the day because of your point. There's so many exit strategies, right? Because you can, I always just go back to the most basic exit strategy is you get the tenant out, clean it up, and you can sell it to a homeowner, right? Last I checked, everybody needs a place to live.
And it's only going to get worse and worse and worse because people are having a lot of fun out there and creating a lot of families, right? And I don't see the builders, at least in the areas I'm in, there's still no builder activity. The loans are too costly for them. Not saying it's not happening at all, but I'm not seeing the bigger builders go out and build at scale like we did previously, right? COVID kind of shut it down, and they really haven't started since COVID again. They may be picking and choosing 8 homes here and maybe smaller lots, but they're not going and building, at least the areas I'm in.
Yeah, I mean, it's a math game, right? So if you just want to talk to data for a second, home building's up 40%. The cost to build a new home, the cost to renovate a home, maintenance, it's all up 40+% since COVID. Real estate home values across the country are up 22%. So if you think about it, right, it's going to cost me 40% and I'm only going to get a 22% increase. I'm down 18%.
That's right.
At scale, numbers don't do math. They don't add up. 18%, you're bankrupt, right, at the end of the day. And so they can't. That's right. To your exact point. And so that's ultimately what happened. Now, there's a lot of stuff coming on market right now in the big cities because they were already being built. Yeah. And so there's more coming on, which is like places like Florida down here. Rent growth is actually negative because of how much supply has come online recently. And so the reality is, though, it's a cycle because guess what? Now nobody's coming to Florida. Right. Nobody wants to invest in Florida. I was on a call with a bunch of big investors, and pretty much it's a big red X on Florida. Do not touch Florida right now for those reasons. Well, guess what? Now all of a sudden we're going to eventually get back into the demand cycle. That's right. It's going to come. So, for me, it's location based, of course. And that's why the other thing I always say is know your market. Know the market you're in. Know where you're at. Know what you're investing in. For us, it's really easy. I'm in Pittsburgh. I live there. I know the market really well.
And you know that, and I go the other route, right? I'm on the other side of that coin where I say you don't necessarily need to live in the market you're investing in.
No.
And the reason why I make that argument, I'm sure you can at least agree with this point, none of the big money, the funds, live in the markets. They do this all virtually. They have a great back end. They have a great team. Yes, they have all the money to go afford all that. But if they can do it, so can the little guys, so can we, right? So I can go buy in Birmingham, Alabama, Pensacola, Florida, Charlotte, North Carolina, Oklahoma City, all the places I'm buying in. I've never even been to the state of Oklahoma. I've never been to the state of Alabama, and I have more real estate in those 2 states than anywhere else in the country. And I've never made it in the state.
That's amazing.
But
you should be proud of yourself for that because even me, who's I'm an accountant, extremely conservative, but I do take risks. Like, that scares me. So that's amazing that you do that, for sure.
It's a risk tolerance, but it also is based around growth, right? I know where people are going to ultimately end up growing and living, and I bank on big colleges, big sports teams. I mean, that's really the two things I really look at and say, okay, do we have a big college? So there's always going to be some level of economy, because when was the last time Oklahoma University, when was a big college like that ever go out of business? Never.
They don't.
Right. So, but I wanted to highlight something, because I want to transition this into your back end and dialing in the numbers and understanding what it takes to build a $100 million portfolio. You rely more on your back end. You have a company called Accruity.
Yep.
They do my books because of the importance of this, right? So the closer we've got, I understood your model, and I said, okay, well, if you have a team that can do the same thing for me that they're doing for you, I'm in. So if people need bookkeeping and accounting services for real estate specifically, where can we have them go?
Yeah, so maybe I'll just give a 2-second backstory on it all, right? The way that we built our portfolio was accounting. I'm not a real estate guy. I am now, and I know deal making extremely well, but when I started 5 years ago, I had no real estate experience, right? And so we were able to build a business using purely numbers. Like, that's what I look at. Is this a good deal or not? Then how do we scale it using numbers? And so about 2 years ago, when we were probably 60, 70 million, something like that, we said, hey, look, we realize, especially, getting into masterminds and meeting a lot of incredibly talented salesmen, entrepreneurs, people doing flips, making millions of dollars a year, that we could really help them, because we realized that, I'm speaking to a lot of you out there where your back office is probably a mess. If you're answering the question, how do you manage your business? Well, how much money's in the bank account? Like, that's a problem. And one day there's going to be no money in that bank account, right? And so, we realized 2 years ago, we can really help a lot of people scale their business, scale and keep more real estate to get bankable, to be able to go to banks and get more money from them to scale, right? A lot of good friends, and because, a lot of people in the industry that I've been meeting, like, they're good people. I want to help them. So that's when we spun out Accruity. Accruity is the name of our, accounting business, and we only focus on real estate investors, any vertical in the real estate space, right? So if you're a flipper, a wholesaler, you have a brokerage, you have a team, anybody in that space that doesn't have a good back office, right? To me, fundamentally, bookkeeping is core to everything that you do. You have to be able to make sure every transaction that's happening is being accounted for the right way. Going all the way back to high school, bro, I got kicked out of art class freshman year. Go figure. Not very art. I don't even write anymore because it's so bad.
Yeah.
And I got stuck in accounting. And my teacher, my sophomore year in accounting class in high school, said accounting is the language of business. And it's always resonated for me, because it is. Everything that happens in business, guess what? It equates back to money, which is a transaction, right? A transaction occurs. We exchange something.
Yeah.
And it always has to equal on every side. Yeah. Well, that's bookkeeping. And if you don't understand where every dollar is going, where all of your money is being spent, and what it's returning for you, right? Because why do we spend money? For one reason, to get a return. Yeah. In two ways, certainly. One is time. What do we want to do with our time, though? Go make more money. Or two is to get a return on that money, right? Whether we're putting money into a home, right? Marketing, people, anything that we're spending money, it's to get something back.
Yep.
And so if you're not understanding what it is that you're getting back and when, then you're fighting a losing battle. You're not really speaking the language of business, which is, when am I going to get my money back, or my time back, to go create more money, right? So we created that company literally just for that, so we could really help folks like you who are really good at selling, really good at business, really good at all those things, that don't have the time, capacity, desire to make sure all of that back office is fundamentally perfect. Instead, we'll do all of that work for you, get it nice and cleaned up, get it perfect, and then we'll meet with you once a month if you want it. Some people don't even want it.
Sure.
They just want to know it's safe.
Yeah.
Right? And we'll have a conversation around what that looks like for you and how you can go make more money using that. So Accruity is the name of it. Again, we only focus on real estate verticals, if you will, and our goal is really to help people keep more real estate. And ultimately, the more real estate you keep, we haven't even got into this, the less taxes you have to pay, particularly when you're making money as a real estate agent, investor, whatever you're doing in the space. And so that's ultimately what we're after, to really help as many people as we can.
So if they want to go talk to your team, go to accruity.com.
Yeah, our website's accruity.com. We're in the middle of revamping it right now. We're not the best at marketing. But, over the last 2 years, we've been really focused on helping people. Now we're like, okay, hey, we've really mastered the product itself. We've really built the right team, the foundation, the processes. And so, hey, we can go help a lot more. So now we're revamping the website, 𝐀𝐻𝐨.com. Obviously, they can reach out to you, bro, right? Like, obviously.
So just on the application, I'm assuming there's some sort of application they fill or something?
Yeah. Connect with us. Shoot me a message on Instagram, 𝐀𝐻𝐨_Quinn, Facebook. However you want to get a hold of me, right? We're happy to have a conversation. Essentially, we call them exploratory calls. Everything's sort of specific to you. At the end of the day, your business, everybody has different things going on. The reality is a lot of people that are doing business already sort of have something in place, whether it's an old bookkeeper, probably a lot of times they have a CPA that doesn't know how to do their books, right? And they're all frustrated with their existing CPA. But however you get a hold of me, right? Obviously, make sure you let me know that Justin sent you through his following, through his podcast or whatever. And, I'll personally jump on an exploratory call with you. I like to take a lot of those calls early on to make sure we're a good fit early on. Not everybody's a good fit for us.
There's a lot of people out here like pad split world, right? So like if you're doing any pad splits, fix and flips, buy and hold long-term, short-term, mid-term, like this is so important for you guys to understand the power of understanding your numbers, your P&Ls. Are you actually making any money? To your point, right? Whether it's you're getting some tax write-offs because you're buying some commercial assets, whether you're barely breaking even, but it's okay because you have, 50% equity. There's a lot of these things that you need to understand how to run the actual business side of it. Don't just go buy a rental to buy a rental because you read Rich Dad Poor Dad. So you're like, I got to go buy an asset, because that can quickly turn into a liability
for sure
if you don't know how to run an actual business, which even one rental is like a little mini business, right? And you got to know how to run it. So 𝐀𝐻𝐨.com, let him know you heard him on the podcast. Let's not end here though. Let's talk a little bit about the ability to scale and understanding your numbers on acquisition costs. This is kind of where I was going a little bit with, like, there's so many ways. If you know your numbers, you can pay yourself on the front end, you can pay yourself in the middle, you can pay yourself on the back, right?
Yep.
But this is understanding, how much does it cost you to go acquire that property? What's involved in the cost? Let's dive a little bit more into that.
Yeah, for sure. To your point, I'll touch that first. You could pay yourself a bunch of ways. We do, right? Yeah. We have an acquisitions company. Every deal that we buy, we make $10,000 on it. Our acquisition company does. So this year we'll buy 120 homes that we add to our portfolio, 10 a month. That's $1.2 million in revenue from my acquisitions company, right? The reason we need to do that and the reason we charge $10K is because we know exactly what it is that we're spending every single month to find the deals. Right? Because listen, I'm not out finding deals. I'm here hanging with you. I'm running a business. I'm running the accounting business. I'm running our business. We got 1,000 units. We have $4 million a year property management company, $13 million a year construction. Like, I don't have time, right? So we need to be in the numbers, understanding exactly what it is that's costing us every single month to go acquire this real estate. And the really key metric here is we might spend it today. So we're doing probably, you're probably much better at talking through this than me on our lead generation.
Yeah.
Right. We had like 7 at one point. We're really all the way dialed back down to 2. We crushed mailers a ton, and we're doing our own branded PPC where it's our brand on there, right, to continue to build that in our market because we're only in Pittsburgh.
Yep.
Those are our only 2 right now. And I think we're spending roughly 25 to 30 grand a month on that. But every dollar that goes out the door, we need to know when it's coming home.
Yeah.
And so for us, the $10,000 per deal, and we're running through our KPI metrics to know exactly what it's costing us on a per deal basis for that $30,000, right? Now we're dialing back, we're dialing up. Hey, we're moving more to mailers, we're moving more to PPC, depending on how they're ultimately performing on when the money's coming home, right? What is our real customer acquisition cost for us? It's different if you're running, depending on your business, right? If you're in a coaching business, it's how many students did I get, right? Or whatever that is. It really depends on your business. But for us, it's homes.
Yep.
So what's it costing us to acquire a home? And then we need to make sure the money's coming back. And the way that we run that math is obviously pay ourselves at 10 grand.
Yep.
The 10 grand is based on historical averages of what it really is going to cost us.
If you're buying 10 a month, you're spending 30, you're making 120, right?
Yep. Exactly.
So it's a nice little ROI.
Yeah.
And those numbers have to work on the back end, right? Meaning,
yeah, and then the other piece is you need to understand what your overhead costs are.
Totally.
And that is need to evaluate in, right? We have people that do all of that work for us. Now, we've been able to scale our company that it's not us doing it anymore.
Yep.
So
the other component of that is if you're going to pay yourself in the front end, you need to make sure that there's still a back end profitability, right? And this is why I say there's times, not even paying myself on the front end, but there's times where just because the interest rate becomes so low, I'd rather just go take the quick cash and turn it. But the reason why I say that is because I'm in the volume game for the rest of my life. Like, I don't ever see myself leaving real estate, right? So this isn't a quick turn and burn, 2 or 3 years. So I don't mind taking some chips off the table if something turns into like $78 a month net to me, but I can go make 40. I'll take my 40 because I'm not going to stop buying next year or the year after. I can continue to accumulate and double and triple down when the interest rates are a little bit better. It doesn't mean it's still not a good time. But that's why I'm willing to do that, is because after all the costs come out, after the $10,000 to yourself and all these other things, you need to make sure it's still a profitable scenario.
Yeah, right? and like that example for sure, if it's that easy, if you will, hey, I can go make $40,000 on a wholesale flip deal, or I'm getting $78 a month on that back end. The really cool thing, by the way, is you know those numbers now.
Yeah.
Like, you've learned that, hey, if I go buy this, I renovate it, I burn it, I go to a bank afterwards, and I get all the way through, it's going to be $78 a month.
Yeah.
Right? You see all that to know, hey, no, I'll take 40.
Yeah.
The reality of it is nobody's doing that.
That's right.
But they need to be doing that to say, hey, look, maybe that 78 is actually $500 a month, right? $6,000 a year. And, oh, by the way, I'm buying in a market that's going to appreciate a ton, or $40,000 less $10,000 selling costs, right? So it's 30 or $6,000. Like, what is better then? Oh, by the way, if I do that, I'm going to pay taxes on my 40. You know, I'm in a high tax bracket, or massively evaluating all the way down to the very end of what I would say IRR. I don't do that on every deal, but that's the real way to do it.
It is, my business model is very similar to yours, I think, in the sense of every property I buy, I do the same thing. I underwrite it the same way. I'm doing a full remodel on every single property. That way, if it works for both, I green light the property no matter what. And then I figure out at the end of the remodel what I want to do. The other component, what you're talking about, is paying yourself on the front end. People fix and flip because they think there's a bigger payday. Sometimes there is, sometimes there's not, right?
Yeah.
We just did a fix and flip. It took us almost 9 months. We ended up breaking even because the city stopped us, and then we had to fix this thing that was over budget and all these different things. And you're like, what if that was the only flip I was relying on for income? That's not very fun, right? But if people could understand the numbers that you're talking about, they could wholesale a flip to themselves, run a model like myself where you basically say, I'm either going to flip it, instead of making 40, I'm making 30 on the back end because I already paid myself in, or I'm going to keep it and I still made $10,000 because the numbers are so good, the equity is so good, I'm willing to take $100 a month. They would actually keep more because they're paying themselves handsomely on the front end. This all goes down to negotiating and getting the right deal, right? You can't just arbitrarily do this. But people would keep more properties if they understood the model of wholesaling it yourself, taking an acquisition fee, wholesale it yourself, whatever you want to call it. On the front end, they'd keep more properties rather than going for the fix and flips.
Yeah. And like, to get really granular for a second, I'm not expecting everybody to do this, particularly if you're buying one a quarter, which hopefully everybody starts to doing as of today, right? But like, we have asset managers in place now for our business. We charge 2% to every property that's in our portfolio, 2% asset management fee per month. Our asset managers are now evaluating, right? When we buy a home and we go to renovate it, you said you fully got it, not fully got it, but you fully renovate it, whatever that looks like for you.
For your exit, take it to market, right? Everything looks like a flip.
Yeah. And the valuation is that we need to look at on the back end is how is that reducing my maintenance costs if I decide to keep it? It significantly is. And you can start to evaluate over time how much. For us, because we have asset managers in place, we actually do the evaluation to say, hey, look, we could fully renovate it for $50,000, or we could put $35,000 into it, save $15,000, knowing that it's going to increase our maintenance costs 3% over the next 3 years, and then we'll add in $8,000 in 3 years, and then refinance it again at that point in time because it doesn't need a new roof yet, right? Or, hey, you know, we're not going to go fully renovate this bathroom. We know we could get an extra $80 a month in rent, but it doesn't make sense because it's not going to change the appraisal.
That's right.
So we're not going to get more money out of it. Let's not spend that $10,000 on the bathroom. Let's add it to our asset management list. And 3 years from now, let's do it then when we think the rates will be better. We're going to sell it, right?
Yep.
And so we're doing all kinds of CapEx evaluation too, where we're now, you think about it, right? How many homes we're buying. If we do that for 25 homes, That's 150 grand in cash by evaluating that and then just making sure we're putting it in the asset management plan. We're okay having a maintenance guy go out once every 6 months to fix the toilet.
Yeah,
we didn't replace because it's, obviously the less you fully renovate, the more maintenance costs you're going to have. And so then we put those in buckets. Hey, we're at 11% maintenance. Our goal is always 8, but we save 15 grand. We're okay paying 11%
you're
maintenance
definitely getting
costs.
People
right?
just went like this.
Yeah. So
I get it, and I'm actually thinking right now.
Those are the things you do, but that's how you scale. That's how you go from 0 properties to 1,000 units plus a ton of flips along the way in 5 years.
That's why they need
to evaluate the numbers. 100%.
They need it, and I'm telling all of you watching this on YouTube, listening to this on Apple, Instagram, you need Accruity for this exact reason. If you have a team that can manage to these numbers, that would change whether you put 50 grand in or 35 grand, to his point, and then you can move a lot faster. If you have another 15 grand in your pocket, you can buy probably another rental that year, that quarter, that month, just because you saved some money on that.
I know we're doing a raising capital masterclass next few weeks.
2 weeks in Seattle, yeah.
A few weeks in Seattle. If anybody's in Seattle, you should come out to that. What I would like to do is really run through a powerful example of cost of capital and how important that is to deal making, right? I can't tell you how many people I've talked to, students, different things in the past, where they'll wait 3 weeks for to save $200 on a window, right, on the renovation or whatever it is. And they're not evaluating the real cost of capital that it's taking them. And I don't care if it's their own money. You have to put a premium on, even people have a lot of money and say, it's just my own, whatever. That's still real cost of capital. Like right now, you could put it in a bank and make 5%.
Yep.
So every day that you're not evaluating that, you're losing 5% in that example. For us, I started with no money, bro. Like 5 years ago, we had nothing and nobody would lend to us because I didn't have a balance sheet. So we were paying premiums through the roof, 20, 23%, 25% certain deals. And one point in time, I'll never forget the example. I was paying $59 every day on one deal in my cost of capital. I'm like, so 4 days, the difference of $200 in a window, I lost, right? I don't care. Spend $2 extra, get the damn deal done, right? Because I'm paying so much of my cost of capital. Right. The example that I'll give around the cost of capital and ultimately on keeping the asset long-term over 5 years, how much wealthier you can ultimately get on both of those, man, it is staggering the difference, right? I'll tell you what the difference is. I'm sitting here hanging out with you. 5 years ago, I couldn't rub a penny and a nickel together. I had no money, right?
Now you have a $100 million portfolio.
Now I have a $100 million portfolio.
I'm going to catch you, dude. I'm getting there.
I want you to. I want to help you get there. I am helping
Let's
you
go.
get there.
You are. Guys, I appreciate this. If you love this, you should. Make sure you're following Casey Ryan Quinn, Instagram, Facebook, everywhere else. And if you are already active in investing, wholesaling, flipping, or buying rentals, make sure you contact Accruity.com or just hit up Casey Ryan Quinn because he'll just direct you in the right place. He'll jump on the call with you, all that kind of good stuff. So I appreciate you being here, bro.
Appreciate you having me. Keep more real estate in your portfolio. You'll thank yourself later.
Let's go. That's it. Another great guest on the next episode. Peace.